There's a number sitting in a government document right now that could cost you $2,300 per year, every year, for the rest of your life. And almost nobody planning a Roth conversion in 2026 knows it exists. If you cross this number by one single dollar, Medicare will charge you the full penalty. Not a sliding scale, not a phase-in. $1 over and the bill arrives. The worst part, you won't find out until 2 years after you've already made the mistake. I'm going to show you the exact number, the exact bracket, and the exact planning move that protects you. Stay with me, because the timing window I'm about to explain closes faster than you think. Meet Michael. Michael is 62. He has $600,000 in a traditional IRA, and his accountant just told him to do a Roth conversion this year before tax brackets shift again. Michael's accountant is right about the conversion, but Michael's accountant forgot to check one thing. And that one thing is going to cost Michael almost $5,000 in 2028, when he is already retired, already on Medicare, and already past the point where he can fix it. By the end of this video, you will know exactly what his accountant missed and exactly how to avoid it yourself. Here is what most people understand about Medicare. You turn 65, you sign up, you pay a premium, you get coverage. The standard premium for Medicare Part B in 2026 is $202.90 per month. That part is simple. Here is what most people do not understand. If your income crosses certain thresholds, Medicare adds a surcharge on top of that premium. The surcharge is called IRMAA. It stands for Income-Related Monthly Adjustment Amount. The name is boring on purpose. It hides what it actually is, which is one of the most expensive cliffs in the entire United States tax code. And it is not based on what you earn the year you pay it. It is based on what you earned 2 full years before. Let me show you exactly how this works. This is the official 2026 IRMAA bracket table from the Centers for Medicare and Medicaid Services. You can pull this up yourself at cms.gov. Look at the first threshold. $109,000 for a single filer. $218,000 for a married couple filing jointly. If your modified adjusted gross income from 2024 was even $1 over that line, you are in the first IRMAA tier for 2026. That tier adds $81.20 per month to your Part B premium, per person. So if you and your spouse are both on Medicare, that is $162 per month, or $1,949 per year, in extra premiums you would not have paid if you had stayed under the line. That is the cliff. $1 of income, almost $2,000 of penalty. Every single year your income stays above the line. But here is where it gets worse for Michael, and probably for you. Because if you are doing a Roth conversion, you are not just risking a small slip over the first bracket. You could be jumping 2 or 3 brackets at once. I'll show you the math in a second, but first you need to understand the timing. Medicare does not look at your current income. Medicare looks at your tax return from 2 years ago. Your 2026 IRMAA bill is based on your 2024 return. Your 2027 bill is based on your 2025 return, and your 2028 bill is based on your 2026 return, the one you are filing next April. This is the part that traps people. You can do a Roth conversion in October of 2026, feel great about it, file your taxes in April of 2027, and not see the Medicare consequence until your premium notice arrives in late 2027 for the 2028 plan year. By then, it is too late to undo. You cannot recharacterize the conversion. The tax code closed that door in 2018, so the income decision you make this year does not show up on your Medicare bill until 2 years from now. Most retirees only learn this rule after it has already cost them. Let's go back to Michael. He has $600,000 in a traditional IRA. His other income before the conversion puts his modified adjusted gross income at $105,000. He is single. He is $4,000 under the first IRMAA bracket. His accountant suggests converting $150,000 from his traditional IRA to a Roth. Sounds reasonable. The conversion is taxable, but he locks in today's rates and his future Roth withdrawals are tax-free. Here is what the accountant missed. Adding $150,000 of conversion income to his $105,000 baseline puts Michael's Magi at $255,000 for the year. Look at the bracket table again. That is not just over the first cliff. That is over the second cliff. And the third. In 2028, Michael's Medicare Part B premium goes from $202.90 per month to $405.80 per month. He also picks up an additional Part D surcharge of about $35 per month. Combined, that is roughly $2,800 in extra premiums for that year alone. If Michael had spread the conversion across 3 years instead of doing it in one, staying just under the first bracket each year, his total Medicare penalty would have been zero. This is the part nobody talks about. The Roth conversion advice you read online almost always says, convert as much as you can in low-income years before required minimum distributions kick in at 73. That advice is not wrong. It is incomplete. It assumes the only cost of a conversion is the income tax you pay on the converted amount. It ignores the IRMAA cliff entirely. For a married couple where both spouses are on Medicare, crossing into the top IRMAA bracket can add over $13,000 per year in combined Part B and Part D surcharges. That is the equivalent of paying an additional 8 to 10% on top of your federal tax bill just on the conversion, and it is invisible until it shows up 2 years later. I want to be honest about something here. There are situations where blowing through IRMAA brackets is still the right move. If you are in your early 60s, not yet on Medicare, and you have a multi-year window before age 65, the math changes completely. That is exactly the planning window the smartest retirees use. Here is the move. 3 steps. Step 1. Before you do any Roth conversion, calculate your projected modified adjusted gross income for the year, including the conversion amount, not your taxable income. Modified adjusted gross income. They are different. Step 2. Compare that number to the IRMAA bracket table for the year your conversion will hit your Medicare premium. So a conversion in 2026 should be checked against the projected 2028 brackets. The brackets adjust slightly for inflation each year, but the first one is moving by only 2 or 3% annually. Step 3. If your conversion would push you over a bracket you do not want to cross, split it. Convert part of your IRA in 2026, part in 2027, part in 2028. You pay roughly the same total income tax. You pay zero extra in Medicare premiums. There is also a special case. If you are not yet on Medicare and you are between the ages of 59.5 and 65, that window is the most valuable Roth conversion window of your life. Conversions you do in those years do not count for IRMAA purposes because you are not on Medicare yet. The 2-year look-back only matters once you enroll. That window closes the year you turn 63 for most people, because that is the year that determines your first Medicare premium. One last thing you need to know. If a major life event causes your income to drop, you can appeal the IRMAA determination. The form is called SSA-44. Qualifying events include retirement, death of a spouse, marriage, divorce, or loss of income from a property. A Roth conversion is not a qualifying event. Selling a house and triggering a capital gain is not a qualifying event. A one-time bonus is not a qualifying event. The list is narrow on purpose, so do not plan around the appeal. Plan around the bracket. The IRMAA cliff is one of the few financial penalties in the United States tax code that punishes you for income you earned 2 years ago. It rewards retirees who plan ahead and quietly bills the ones who didn't. If you found this useful, the next video in this series covers required minimum distributions at 73, which is the other side of this same trap. The IRS forces income out of your traditional accounts. IRMAA penalizes you for receiving it. Watching both videos will give you the full picture. Thanks for watching. I'll see you in the next one.